moving averages are a lot like gravity. So the further you get away from them, the further you deviate from that average, because an average is price over time, so you have to trade both above and below that average over a particular time frame. That's what creates the average. So they're like gravity. The further you get away from them, the more that they want to kind of come back to earth at some point. All right, let's talk a little bit about what you need to know before the bell this morning. Market started off a little bit weak and then just had a nice strong rally all day long, finished up near the highs yesterday. Market did move up to 54.70 yesterday, so about a 1% advance yesterday, very nice. But while markets are making that advance, they're doing so on a couple of things. First of all, volume has been a little bit weaker. Breadth continues to weaken fairly markedly, but importantly, we are now very, very overbought. And I mean, not just a little bit overbought, we are very, very overbought, at this point in terms of relative strength. Also, the current deviation from the longer term mean is getting fairly extreme here, and is something worth continuing to pay attention to. With that overbought condition, this deviation from the 50-day is getting fairly extreme. We kind of covered this yesterday. Typically, when we have deviations of kind of this magnitude, you eventually are going to get a correction back to that moving average. Moving averages are a lot like gravity. So the further you get away from them, the further you deviate from that average, because an average is price over time, so you have to trade both above and below that average over a particular time frame. That's what creates the average. So they're like gravity. The further you get away from them, the more that they want to kind of come back to earth at some point. So again, with this deviation that we've got currently set up between the price of the market where it is now and those underlying moving averages, with the market overbought at the same time, some type of corrective action here won't be a surprise. Nothing major, but a correction back to that 50-day moving average is going to be roughly about a 4% decline. It's not insignificant, but with the markets having been so kind of non-volatile as of late, at 4% correction is going to feel a whole lot worse than it is. Kind of think about the way you felt back in kind of April when we had a 5% correction. We had people getting very, very like, oh my gosh, what's going on with the markets? That was a very normal correction, low volatility, normal correction, back to the moving average. It came right down to the 100-day moving average, held onto that. 5.5% correction, people were under a lot of pressure because of the decline in the markets. Because this market has been accelerating again along that 20-day moving average, we've had a nice advance here over the last couple of months. When we do get a correction, now it doesn't mean a correction has to start tomorrow, but when we do get a correction, it'll be 3 to 5%, and it's going to feel just like it did in April. It's going to just feel a lot worse than it is, and that's because we get into these really complacent positions within markets where it's like, oh, this market just goes up every day. Whatever I buy, it just goes up. It's all great. And then when something goes wrong, you find out just how much risk you got. And again, with investors really piling in to just a handful of stocks, they're taking on a lot of excess risk. This is part of kind of our technically speaking post on the website this morning at realinvestmentadvice.com. Investors are becoming very aggressive about their equity allocations, and they're tending to do that in a more consolidated fashion. So when the correction comes, your portfolio will likely decline more than the markets, because you've taken on a lot more risk than you realize you've taken on, because you've been crowding into fewer and fewer investments, because those are the ones that have been going up versus the other stuff. So again, just be careful here. This is why we consistently say, when you're at these levels, do a little bit of risk management. Take some profits, rebalance your portfolios, reduce stuff back to target weights. Do kind of just follow your protocol to manage your portfolio risk, and you'll do a lot better over time, and then those drawdowns won't hurt as much. All right, that's what you need to know before the bell this morning.